Intel is now trading at a valuation that would normally belong to a fast-growing software company. Its forward PE is close to 100 times earnings on one source, and another has it at 125 times. Its trailing PE is above 900. The company is still reporting negative net income, a negative profit margin, and negative free cash flow. And yet, the stock price is already assuming a major turnaround. The bull case is obvious. Earnings could recover sharply from a depressed base, but that is exactly the problem. Investors are not buying a proven recovery, they are paying today for several years of recovery that still has to happen. In this video, I am going to show why Intel's valuation has become extremely difficult to justify and why I do not want to buy this stock at this price. Yahoo Finance shows Intel at approximately 125 times forward earnings. The trailing PE is above 900 because current earnings are almost non-existent. The stock also trades near 9.6 times sales and more than 10 times enterprise value to revenue. Enterprise value to EBITDA is shown at approximately 49 times, and those are premium valuation levels. But the underlying company is not currently producing premium financial results. Not even close. The last 12-month profit margin is negative 5.9%. Net income is negative 3.2 billion, and levered free cash flow is negative 8 billion. This is the central mismatch. Intel is being valued like a successful high-growth company before the financial recovery is even visible from space. The historical chart makes the valuation expansion even clearer. For years, Intel generally traded between 10 and 20 times forward earnings, and that made sense for a cyclical semiconductor company with modest growth and heavy capex requirements. Beginning in 2023, the multiple became far more volatile as earnings collapsed and recovery expectations moved around. Today, the forward PE is close to 100 times forward earnings. That does not mean that Intel suddenly became a 100 times earnings quality business though. It means the earnings denominator is still extremely weak, while the stock price is already anticipating a massive recovery. The valuation is being supported by hope about future earnings, not by the profitability Intel is producing today. At first glance, the analyst growth estimates look spectacular. Consensus EPS growth is shown at approximately 162% for 2026 alone, followed by roughly 44 and 53-64% in the following 3 years. And these percentages look amazing, but they lack context. Intel is recovering from an extremely depressed earnings base. When earnings rise from almost zero to a small positive number, the percentage growth can look enormous even though the absolute earnings remain modest at best. That is why, despite the expected 162% earnings growth that we expect in 2026, Intel has an estimated PE that is still close to 100. Even after several years of projected recovery, the estimated PE remains around 69 in 2027, 45 in 2028, and 28 in 2029. So, Intel is not rapidly growing into a normal valuation at all. The current share price already appears to include multiple years of successful recovery, and it's, in my opinion, more than 3. Later, I will turn that 2029 multiple into actual share price scenarios so that we can observe that, because that shows more clearly how much of the recovery is already embedded in the stock. Notice that Yahoo Finance does not provide a 5-year PEG ratio for Intel. This is not a simple missing data problem. It is a warning about the quality of the inputs themselves. The PEG ratio requires a usable forward PE and a stable long-term earnings growth estimate. Intel currently has negative trailing earnings and a highly unstable recovery path. A mechanical calculation using the 2026 growth rate could make Intel appear cheap. For example, dividing forward PE near 100 by growth of approximately 162%, then we get to a number that is below 1. Obviously, that result is misleading. The growth rate is inflated by the depressed starting point, and it represents one recovery year rather than a normalized long-term growth rate that is achievable. The missing PEG ratio tells us that the standard growth-adjusted valuation framework is definitely not reliable here. Intel's earnings are simply too unstable for a clean conventional PEG calculation. This is the distinction that investors need to make. Intel can improve dramatically from very weak periods without becoming a strong business at the current valuation. A turnaround can produce large percentage improvements because the starting point is crap, basically. And that does not automatically create attractive economics, though. What matters is whether Intel can rebuild revenue growth, gross margins, operating margins, and earnings per share to the levels that support the current market value. The company needs more than better numbers, though. It needs a durable improvement large enough to justify a valuation that is already far above its historical range. And at this price, merely becoming less bad is not enough at all. One comparison that makes this even harder to ignore is TSMC. Taiwan Semiconductor is the foundry benchmark that Intel is trying to catch, and operationally, it is in another league. In its latest quarter, TSMC delivered a 67.7% gross profit margin and a 60.3% operating margin, while Intel Foundry reported an operating loss of roughly $2.4 billion in the first quarter alone. And yet, Intel's forward earnings multiple is currently much higher than TSMC on major market data sources. And this is not a perfect apples-to-apples comparison because Intel's earnings are unusually depressed, sure, but it shows how much future execution investors are already paying for. In other words, Intel is being valued currently for a level execution that is quite close to what TSMC is delivering today. The cash flow picture is another major concern. Intel is not an asset-light software company. Semiconductor manufacturing requires enormous capital investment. That means operating cash flow is alone not enough. Investors must subtract capex to understand what remains for shareholders. And Yahoo Finance shows negative levered free cash flow of around $8.3 billion over the last 12 months. And this matters because the turnaround that we were talking about earlier requires continued spending. Intel needs to fund manufacturing capacity, process development, and foundry ambitions before the economic returns are even proven. The company may eventually generate strong free cash flow, I'm not denying that. But the market is already valuing Intel as though that outcome is either increasingly certain or it's already happened. Now, let's turn that valuation into actual share prices. To be generous to the turnaround case, I do not want to value Intel on today's depressed earnings, and instead, I want to assume Intel gets all the way to the 2029 earnings level implied by the analyst estimates. With the stock around $97 and the projected 2029 PE near 28, then the market is implicitly valuing roughly $3 and about 47 cents of 2029 earnings per share. Let's call that earnings assumption constant and change only the valuation multiple. At 10 times earnings, Intel would be worth about $35 per share. At 15 times, it would be worth about $52 per share. And if we take that to 20 times earnings, then we would have a stock price around $69. If we want to exaggerate and go to 25 times, then it would be worth $87. And around 30 times earnings, we would have a stock price at $104. If we want to get even more crazy, let's have 35 times earnings, which would give us a stock price at $121. This is not a price target. It is an analysis for sensitivity. It shows what exactly the same 2029 earnings stream could be worth under different valuation assumptions. And we are not too far from those prices at all, from a current value at least. And that is why the current price becomes very difficult for me. If Intel successfully reaches those 2029 earnings, but the market eventually values the company at 20 times earnings, the implied share price is at around $69, so it's about 30% below $97. At 25 times, we would have a stock price at $87, still below the current price. So Intel needs a multiple above roughly 28 times those projected in 2029 at least, to justify and support a share price around today's level. So the current valuation is not merely assuming an Intel earnings recovery, it also assumes that after the recovery, investors will continue to award Intel a premium earnings multiple. And if the earnings recovery falls short even by a little bit of the current estimates, every number in this table moves quite a bit lower. The valuation table makes the problem much more concrete. For Intel's current price to work, several difficult things must happen. Earnings must recover rapidly, gross profit margins must improve, the manufacturing roadmap must execute flawlessly, foundry losses must become manageable, and capital expenditure must eventually produce actual attractive returns. And competitors cannot pull further ahead while Intel is rebuilding. But there is one more requirement. Even after the earnings recovery, the market still has to give Intel a relatively high valuation multiple. Any one of those outcomes is possible, and the problem is that today's valuation appears to require most of them to happen together. This is why I do not want to buy Intel stock at the current price, or anywhere close to, for that matter. I am not saying that the company cannot recover. It may recover substantially. I am saying that the stock offers very little room for that recovery to disappoint. At roughly 100 to 125 times near-term forward earnings, with current weak profitability and negative free cash flow, I would be paying for the turnaround before it has even been demonstrated. And even if I give Intel the benefit of the doubt and assume that the company reaches earnings level implied by the 2029 estimates, valuation still matters. A 20 times multiple on roughly $3.47 of earnings produces a share price of around $69. At 25 times multiple, then we would have a $87 stock. The current share price therefore needs not only the earnings recovery, but also a premium multiple on those recovered earnings. For a capital-intensive semiconductor company, that is most definitely not an obvious bargain. I would rather miss the first part of the recovery than pay a premium price for a turnaround that has possibly the highest risks in modern business. The bull case deserves to be acknowledged. Intel has valuable technology, strategic importance obviously, manufacturing assets and the possibility of a significant earnings rebound. If execution improves faster than expected, the company could eventually grow into today's price. But that is not enough for me, because a good story is not the same as a good entry point. The current valuation leaves too much dependent on future execution and too little supported by present profitability. So, is Intel a bad company? Is not the right question. The right question is whether the current stock price offers an attractive relationship between risk and potential return. Intel still has weak current profitability and negative free cash flow. Its near-term forward PE is extremely elevated because the earnings are depressed. The conventional PEG ratio is not useful here at all because the earnings base is unstable and the headline growth rates are distorted by the recovery from that depressed state. Analysts expect a major earnings recovery. But even if Intel reaches the 2029 earnings level implied by the current estimates, the valuation sensitivity matters enormously. At roughly $3.50 of 2029 earnings, a 20 times multiple implies a $70 share. Almost. 25 times implies about 87 and 30 times earnings is $104 per share. So, that range gives me the entire point. The future stock price depends not only on whether earnings recover, but on what multiple investors are willing to pay once that the recovery is actually visible. My conclusion is simple. Intel may improve, I'm fairly certain that it will. I don't know how fast that will happen though. But the current stock price already prices in a massive part of that improvement and still requires a relatively generous valuation multiple to produce attractive upside. I don't need to bet against the company though. I simply don't want to pay this price for a turnaround that is still unproven.